If I would say my base case is I would expect to see six figures over, say, the next 3 years.
In today's video, Lyn Alden, an investment strategist and macroeconomist, warns that once the debt ceiling is lifted, Janet Yellen will need to refill the Treasury General Account.
What is the best way to navigate it from a portfolio investment perspective?
So I'm primarily sticking to a diversified approach. I call it the three-pillar portfolio, which is basically one pillar is cash equivalents, money markets, T-bills, things like that. Another pillar would be equities, just long-term compounding equities, being able to absorb that volatility. And then the third would be commodities and hard monies. It's more of the inflation component. From a more tactical standpoint, if someone's trying to trade around this, which is more challenging, I think the kind of prevention there is to somewhat be defensive until you see signs that maybe the liquidity profile is improving. So if you start to see that the Federal Reserve is going to end their quantitative tightening, or you see some sort of realization that they're starting to cause problems in the treasury market and they reverse course, that'd probably be a buying opportunity. But I think until you see signs of liquidity kind of stabilizing after this debt ceiling, I think it's worth being defensive.
Okay. And the best way to be defensive?
Probably focusing on money markets, because you have cash equivalents without much counterparty risk, and your biggest counterparty is the Fed rather than the Treasury that might ironically temporarily default on you. So I think money markets are pretty attractive, and I think in general just diversification. So having defensive equities. I've been pointing out things like energy pipelines, for example. If someone doesn't want the volatility of the producers, I think a number of the highest quality pipelines are actually pretty attractive in this environment. They've kind of washed out a lot of their leverage. Their valuations are cheaper. So I think more income-focused kind of recession-resistant businesses along with money market exposure is a good way to kind of be defensive until you see signs of a liquidity change.
How do you see Bitcoin fitting into this picture? We have seen a theme in this conference is that the banking crisis is driving more interest into Bitcoin as an alternative to traditional finance. How are you seeing that play out?
So I think on the surface, the narrative is pretty clear, where basically it's, the banking system's unstable and people say, well, I can self-custody money with Bitcoin. I don't have to worry about counterparty risk. I think that's part of it, but I think probably the bigger move is basically due to markets repricing their forward expectations for how aggressively the Fed can hike rates. So we saw, for example, that, 2-year treasuries, stopped increasing. We saw that, as you pointed out, the market's pricing in cuts by the end of the year. And a lot of that changed pretty rapidly, beginning with the banking crisis. And when you have a softening of forward expectations for how hawkish the Fed can be, then it gives a bid towards kind of anti-dollar trades, scarce assets like gold and Bitcoin. And so I think the biggest move that we've seen probably in this thing is not necessarily the narrative itself, but the kind of the structural market implications of rates. So I think as the Fed shifts from, tighten money as tight as possible, control inflation as much as possible, and instead kind of balance that between financial stability, that's what's given Bitcoin and other scarce assets a chance to catch a bid. I think the challenge is that when we go back to those liquidity questions I talked about earlier, like if the Treasury tries to refill its a cash account really quickly while the Fed's still doing QT, it's probably not going to be good for Bitcoin for, say, a multi-week period, most likely. But when you do get some sort of pivot, either the Fed ends its QT program or has to launch some sort of new liquidity program, or the Treasury has to take some other action, I would be a buyer of that capitulation if you were to get one.
You said earlier that you did think that the bottom was in for Bitcoin. Is that including a scenario where you have the Treasury not play it correctly and drain too much liquidity at once in conjunction with the Fed? Is the bottom still in for Bitcoin in your opinion in that scenario?
So I think most likely, you can never know for sure. I think the prior cycle was instructive on this because, for example, Bitcoin formed a very big bottom in late 2018, early 2019, and then it grinded significantly higher. But then it kind of retested that bottom very briefly during the March 2020 sell-off. And so it didn't hit like lower lows, but it did kind of briefly go back and plumb those depths. And the difference was that it didn't stay there for many months. It just kind of had this like big flick down, and you had the liquidity response, and a number of weeks later, it was already back up to well above that bottom. And I think you could see a similar thing where you get kind of a brief problem that brings it down maybe lower than we expect. But I don't think it would stay in that lower band anywhere near as long as it did in this.
What is the price range of that lower band that you consider to be the bottom?
I think I wouldn't be surprised to see it touch the lower 20s again if we get that specific scenario of a liquidity crisis from trying to refill the Treasury General Account. There are scenarios that I think could push it to the upper teens yet again. But I think that would be it probably spend less time there than it did in this prior bottom. And instead, if they actually front run this, if the Fed ends quantitative tightening before you get the Treasury pull up, or if the Treasury does proactively kind of focus on issuing T-bills or increasing their Treasury account slower, then I think you're much less likely to retest those lows.
So a lot of to be determined factors on the horizon there, but long term, you're very much a Bitcoin maxi or Bitcoin bull, safe to say?
Yeah, I think the next 2 years or 3 years look very constructive. I think basically we have this window where the next 6 months, there's a lot of variables that I think could throw us off. I think Stanley Druckenmiller said it best. He's like, I can make the case for deflation, or I can make the case for 8% inflation. Mm-hmm. And I think he's touching on the same kind of uncertainties I'm touching on here, which is that there's very key decision points that a handful of individuals can make, and that can determine pretty big swings in what happens. So I think that basically next 6 months for Bitcoin, very unclear. I can make the case for retesting the lows, or I can make the case for, not going below 25,000. But that I think that the 2 year or the 3 year case is very, very strong. I have high conviction that basically we'll probably have another positive liquidity cycle in that environment. And right now the valuation is very attractive, compared to its longer term, say, moving averages. I also think if you look at Bitcoin holding behavior, generally one thing you see in bull markets is that long-term holders begin selling some of their Bitcoin because they're up 5x, 10x, all this new money's rushing in, and they're reducing their positions. When you have bear markets, you generally instead see long-term holders are not selling, that they're buying more. And you start to get a very large percentage of Bitcoin that haven't moved in a year or more. And right now, we're very tight in that metric. Basically, we have a lot of indicators kind of either pointing that the bottom's in, or that the bottom at most is likely to be retested. And so I'm very constructive with, say, a 2 to 3 year view.
How constructive? Do you have a price forecast or a range? I know Standard Chartered, for example, Bank has Bitcoin at 100,000 by the end of 2024. We've had a number of guests on the show saying that is a very likely, probable price point. What does Lyn Alden think?
So I might push it out to late 2025 to give myself more room, but I do think there's a good chance of seeing six figures in this next, call it 3 year cycle. That's not for sure. I wouldn't go levered long and assume that to be the case. I wouldn't build a business specifically that's going to happen, but if I would say my base case is I would expect to see six figures over, say, the next 3 years.
Six figures is in 100,000 or even potentially higher than 100,000?
I think we start with 100,000 or 120,000 and see if we get to that before making higher conviction, higher price targets from there.
By 2025?
Yes.
Is there a signal that you could see happening that would confirm it's looking to go inflationary, or it's looking to go deflationary, or the other side? Is there a particular signal there?
I think the biggest signal is that the Fed has to begin changing its hawkishness, despite the fact that they haven't met their inflation targets. So, for example, if you go back to 2019 during the repo rate spike, in September of 2019, the repo market had all sorts of problems, and the Fed had to abruptly end their quantitative tightening and shift to a form of quantitative easing, and they had trouble explaining why they had to do it. And it was in large part because you had T-bills crowding out bank reserves. And if you see a similar environment where they have to kind of pivot prematurely, and yet that happens in an above target inflation environment, I think that would be a sign that they've kind of lost control of inflation, and that that would be a very strong signal to want to buy other assets, either hard assets or generally anything that would benefit from a weaker dollar at that point.
Make the case for me as to what could potentially derail your thesis. what would need to happen, or what developments that are likely, or not so much likely, but on the potentially viable, that you would need to see to make you change your outlook on Bitcoin, if at all?
So I think the biggest risk, the most likely risk, that would make me not change my thesis, but significantly extend my thesis. Basically, it would radically increase the length of time that the bullish thesis has to play out, is if you had some sort of draconian government crackdown on it. So we've seen a number of countries, Nigeria, Argentina, generally countries that are having some trouble with their currency, cut Bitcoin off from their banking system. So they're not saying it's legal to own it, but they're saying that banks can't send money to known crypto exchanges or known ways to enter Bitcoin. And so it kind of makes the off-ramps from fiat to Bitcoin narrower and harder and more friction-filled. And when those countries do it, it doesn't matter for Bitcoin. It just matters for people in those countries. They have to use more peer-to-peer methods and some more friction-filled methods. But if you were to get that in the United States, I do think that'd be a very significant price blow. I think longer term, it wouldn't change the thesis of Bitcoin, 10 years from now, being much higher than it is. But I think that could add a number of years towards the next new all-time high, or the number of years it takes to get to, say, a six-figure price target. As far as derailing the thesis permanently, I think you'd need something absolutely critical, like a completely catastrophic bug or some other problem with the consensus itself. That would be, I think, the kind of the main thesis, damaging thing from there. And even at that point, there are ways that the network can adjust. You can do basically various forks to fix the problem, but it would damage the reputation of the network if you would have something pretty catastrophic like that happen.